Build your dreams, live rich, and leave
The
rich.
single biggest fear that paralyzes investors, it isn't just losing a bit of money. It's that absolute nightmare of a massive market crash wiping out everything you've worked for just in an instant. It's the reason why so many people pray for stocks to get cheaper, but the moment it actually happens, they freeze in terror. But what if I told you that that very fear, that volatility that scares everyone away, could be turned from your greatest enemy into your most powerful ally? We're not talking about some fancy mindset trick here. We're talking about a cold, hard mathematical system. Let's begin.
So, let me ask you directly. Do you fear a market crash? The question itself is simple, right? But the feeling, that feeling is anything but. Your money's invested, the screen flashes red, and this primal instinct just screams at you. Get out! Sell now before it all goes to zero. Look, that emotional panic is not just normal. It is the single most destructive force standing between you and creating real, long-term wealth. This quote, it just nails a fundamental law of Dalal Street. The stock market is simply a device for transferring money from the emotional to the educated. It doesn't reward panic, it rewards cold, calculated discipline. The whole game is a battle between your gut reaction and your strategy. And the key to winning, truly winning, is to build a system that forces that discipline for you automatically.
And that brings us to the very core of our strategy, the automatic discipline engine. Now, this isn't some new mindset you have to spend years learning. No, this is a tool you simply deploy. An automated system that just works silently in the background, executing your plan without a shred of fear or greed, and most importantly, removing you and all your emotions from the equation.
So what is this tool? It's the Systematic Investment Plan, or what we all call an SIP. And the official definition is brutally simple. You commit to investing a fixed sum of money, let's say 10,000 rupees, on a specific day every single month. That's it. There's no guesswork. There's no trying to time the market. There is only a simple, consistent, automated action. So why is this the perfect tool for a beginner? Well, because it just removes all the complexity. You can start with really small, manageable amounts. It automatically forces you into a powerful saving habit. And it's flexible. You're never locked in. But that last point, the one about protecting you from the market's ups and downs, that's not just another benefit. That is where this entire strategy transforms into a weapon.
All right, so what is this secret weapon? It's not some hot stock tip or a secret market prediction. It is pure, undeniable mathematical principle. It's the engine that's inside every successful SIP, and it is the reason that disciplined automation will always, always defeat emotional panic in the long run.
This powerful concept is called rupee cost averaging, and its true power is in its beautiful simplicity. See, because your investment amount is fixed, your money is forced to buy more units when the price is low and fewer units when the price is high. Your system is literally engineered to automatically exploit market dips without you ever having to lift a finger or think about it.
Let me put it this way. Think about your weekly budget for vegetables. When you go to the market and tomatoes are on sale super cheap, you naturally buy more of them, right? And when the price skyrockets, you buy fewer. Well, an SAP applies this exact same common sense to your investments. It forces you to be a smart shopper in the stock market.
Okay, let's see the math in action. Here's a simple example of a 10,000 rupee monthly SIP. In January, the unit price is 50 rupees, so your money buys you 200 units. Simple enough. But look at February. The market panics. The price drops to 40. Your same 10,000 rupees now buys 250 units. That's 50 more than the month before, precisely because the market was weak. And then, when the price recovers in March, you automatically buy fewer. The system is just working.
Now, if you just took the simple average of the prices over those 3 months, you'd get 48 rupees and 33 paise. That's what the emotional, uninformed investor probably saw. But what was your cost? Your total investment of 30,000 rupees bought you a total of 631.8 units, which means your average cost per unit was only 47 rupees and 48 paise. You paid less than the market average. This isn't an opinion. This is a mathematical certainty. You won because you automatically bought the dip. That right there is the undeniable power of rupee cost averaging.
And this brings us to the final and most critical mindset shift. The very event we are all conditioned to fear, a market dip, has now been revealed, mathematically, to be our greatest ally. It's the precise moment our money works the hardest for us.
So, as an investor, you're faced with two paths. On one side, you have the emotional investor.
They're always trying to time the market, they panic and sell at the very bottom, and they live in this constant state of stress. And on the other side, you have the disciplined SIP investor. They invest consistently, they automatically use dips to their advantage, and they execute a logical, automated plan without any emotion getting in the way.
If you remember only one thing from this entire discussion, let it be this. With a systematic plan in place, a market crash is not a loss. It's not a threat. It is a mega sale. It is a limited-time opportunity for your automated system to acquire world-class assets at a deep discount while everyone else is running for the exit.
By understanding this simple math, you can completely reframe your relationship with the market. That volatility is no longer something to be afraid of. It's the very fuel for your success. So the question is no longer if the market will fall. The real question is, when it does, will you see an enemy to run from or an opportunity your system was built to seize?